All right, everybody, welcome. Some of you are back now. This is your fourth webinar tonight, but for some of you and most of you, this might be your first one today, and I am honored to have you here. And I'm really honored to teach you what we're going to get into, which is risk mitigation. We're going to talk about how to actually take less risk, but make more money. That doesn't seem to make sense, does it? Yeah, well, when I was a financial advisor for 16 years, I never would have said those two together. Take less risk and make more money. But you see, once you kind of disconnect or unplug from that traditional way of thinking, it's very easy for you to make more money by being consistent and persistent, and also by not playing the roller coaster that we call the stock market. I mean, literally, how many of you know that the S&P 500, the returns that you've seen in the S&P 500 for this year, we'll just talk just this year. Do you know that the majority of those returns are made up from 7 stocks? The magnificent 7. I've got the list right here. I'll just tell you which ones they are. It's Meta, Nvidia, Apple, Microsoft, Alphabet, Amazon, and Tesla. So they make up a large percentage of the returns in the S&P. If we remove the magnificent 7, the returns are negative in the S&P 500, probably also negative in the NASDAQ, and probably also negative in the Dow. I'm only focused on the S&P 500 because it's 500 stocks. So that's the best metric for doing that. And out of those 7 stocks, the magnificent 7, they're 92% of the return. Think about that. The entire stock market is being held up by 7 stocks. So does that make you feel good? Some of you are like, well, doesn't make me feel bad. Well, here, this might, because when you look, there was a study done, and I'm just going to go into it. There was a study done, it was a survey that basically asked and looked at a bunch of metrics and factual data to say, is there a recession coming? This is something that a lot of people are asking about. When are we going to be in a recession? What's it going to look like? When's it going to happen? You know, are we going to hit one? Is it going to be a soft landing, or are we going to crash land this thing? It's all over the place. So they did a study in 2020 for 2024 projections, and the Fed says there's a 0% chance of a recession. The Fed, you know, Jerome Powell went on today and held rates. Okay, the market rallied up 200 and some points today. Woohoo! Great job, Jerome. Great job. Now, they're literally just being quiet, letting what the stuff that they did already sink in, which has been raising rates over 5% in about a year's time and unwinding about $1 trillion off their balance sheet, which sucks money out of the markets, sucks money out of the capital banking system. So when you look at it, the Fed says there's a 0% chance, but the yield curve says something different. Now, I brought this chart up behind me because I thought it was kind of neat. You know, what we're going to be doing tonight is we're going to be going over a bunch of really key metrics, but we're also going to talk about being your own bank, and we're going to talk about reducing your risk and making returns. Okay, those are the basically the 3 things we can get across, because I only have a little less than an hour with you tonight, and I'll probably go over about 5 minutes because we started 5 minutes late, but I have an hour with you. And I think you can all agree that an hour is just not long enough to cover all that ground. I'm gonna cover it, but I'm gonna hit high level, right? But I also want to be very transparent, because I know a lot of people, you know, when you come to a webinar like this, you're always thinking, oh, what's the catch? He's going to be giving all this value. He said he's been going live all day long. Like, what's the catch? I'm sure there's a sale. So let's just get that out of the way. Yes, there is a sale for this. And I'd rather just get it out of the way now so we can just focus on me teaching you what you need to know to get you ready for what's about to happen. So this weekend, we have well, Stephen calls it the world famous. I don't know about that, but it is definitely very popular. Our 3-day Money School Essentials virtual training. Friday, Saturday, Sunday, 10 to 4 p.m. Fully recorded, fully edited. If you can't make any of the days, that's what's happening this weekend. We do this about 4 times a year, and everyone is completely different. So some of you are like, I've already gone to that. I've already seen that. You haven't seen this one. It's completely different. Matter of fact, this 3-day training we're doing this weekend, I'm going to be covering a strategy, a risk-free strategy that never before in all the years that I've done this, which has been about 20 years, a little over 20 years now. Okay, 20 years was June. Okay, I've never been able to talk about this. I've never been able to even think that this would work. But right now, because of the Fed's action, the dynamics in the economy and the markets allows this to work. And here's why it's important for every single one of you, not just some of you. It's risk-free. It's a risk-free return. Not only will you get paid today, make a passive income that you don't have to work any harder for, but you're going to make a ton of money in the future because I can tell you exactly what the Fed's going to do. I can show you just in a couple slides exactly what the Fed's going to do in the next few years. And I can tell you exactly why you're going to make a whole bunch of money if you do what I'm going to teach on Friday. But that's just Friday. Not only that on Friday. On Friday, I've got a really special speaker. His name's Cole Snell. Me, Cole, and a bunch of other, I'll say way smarter people than me, economists and everything else, have been working on a project. You see, the problem with the infinite banking concepts and the specially designed whole lives that we use to basically as the machine for the infinite banking concept is it's only available in North America. Do we have anybody on here that's not in North America, the US or Canada? We might not. But wouldn't it be cool if there was a way where the whole world could use the infinite banking concepts, just like we do here in the United States? There's only one path for that to happen. It's called blockchain. And I didn't say Bitcoin or Ethereum. I said blockchain. Okay, that's the only way it could be done. And this team has been working on it. You're going to hear from the owner, the leader, the main guy with this pioneering, and they're really close. Matter of fact, they're already doing it, but they're doing it on an institutional level. Okay, what they're trying to do is, when you look at a bond, when you look at where institutions place their money. So when I say institutions, who do I mean? I mean traditional banks. I mean investment banking houses. I mean Wall Street firms. Pretty much any large business that has capital that just sits that they want to make a return. So where do they mostly put that money? Treasury bonds. But did we not see the risks in treasury bonds a couple months ago when Silicon Valley Bank, Republic Bank, Signature Bank, and a couple others went down? It was because interest rate risk and time risk. Two things happened that brought those banks to their knees. Number one, well, three actually. Banks only have to hold 10% in reserves. It's called Tier 1 capital. How many of you can tell me where banks' Tier 1 capital goes? Who can tell me where that money goes? There's only two places that money essentially can go because they're guaranteed. Number one, whole life insurance, but it's not designed like a regular whole life. It's designed just like how we build policies for the infinite banking concept. That's right, Christian. BOLI, bank-owned life insurance. Look it up, folks. Go to, you can go anywhere. FDIC.gov. Type in BOLI. You'll find an older report from, I think, 2019 that shows top 5 banks had 75 billion of their Tier 1 assets in whole life insurance, BOLI. But the second place they put their money is treasury bonds, all different denominations or different durations, sorry. And treasury bonds, what happened is banks, when they had all the money from the Fed printing, bought a lot of treasury bonds, but they bought them at a premium because interest rates were low during the pandemic. When interest rates are low, price is high on bonds. It's just how it works, okay? It's inverse to what you might think. Interest rates are low, price of the bonds are high. So the banks bought them because they got the yield, they got the interest rate. Then what happened? The Fed, tackling inflation of which they created, instantly started raising interest rates. Quickly, they started raising interest rates, which is where we're at now, because they needed to combat the inflation, which was peaking 9%. And in raising interest rates that quick, the opposite thing happened and the bonds went way down. They went way down. And what happened? There was a run on the banks. And the banks needed to get capital. They needed liquidity. The only place they can go is their Tier 1 assets. Well, the BOLI is usually out working for them. So they had the treasuries. They sold the treasuries at a significant loss. And as the runs continued, as the news perpetuated, the banks had nothing left to give. And that was it. FDIC stepped in. You all know this happened. Okay, so remember, I'm going to get back to these projections. Oh, anyway, what I was saying is this 3-day training this weekend, that's what we're talking about. But I'm going to give you guys a huge discount. And I'm going to have Shauna put it up. Oh, she already did. Look at that. Huge discount, $100 off. And we're going to give you a really, really cool hat that was made just for today. Literally, like we made a special hat that the only way any of you can get it is by registering for the 3-day. And I'll give you one more thing. If you register for the 3-day this weekend, you'll get all the recordings that are edited and timestamped so you can watch whatever you want. We will mail you one of these limited edition hats, of which Shauna might be able to show or might not. I'm going to just continue teaching because I want to get as much out. So this hat, you can't get anywhere else. It's a one-off. So you could sign up for the 3-day. The hat will be shipped to your house. The cost for that is $197 for the 3-day and the hat. And then if you're not happy, there you go. That's the hat. If you're not happy with this weekend's 3-day, if you don't feel like you learned, if you just couldn't make it and you don't want the recordings, ask for a refund. I will give you your money back and you can keep the hat. Fair enough? So it's a risk-free proposition I just laid on you. Risk-free. I'll give you your money back if you want it back, okay? But I can bet most of you will not want your money back after you go through the 3-day because it will be that life-changing. But hey, since we're talking about risk aversion tonight, why not talk about risk-free things like buying this 3-day? So there was something, just put in the chat and we'll keep putting it in throughout the day. That's how you register, and that's what it is. So let's get into this. Okay, right now, those projections in the surveys, the Fed said 0%, but the yield curve said 61% chance of a recession. So what is the inverted yield curve? Well, back in one of the trainings we did a while ago, I showed what the inverted yield curve is. This is dated 3/21/22 all the way through 3/30 of 22. This is the first inversion. And you can see here, this is a 5-year treasury bond and a 30-year. So just think about that, right? You buy a 5-year treasury bond, 5 years from today, you get all your principal back, guaranteed by the full faith and credit of the US government. Plus you got a yield, you got interest paid on that bond. A 30-year bond, which is 30 years you got to wait. Normally the people that buy 30-year bonds are institutions like banks, insurance companies are big purchasers, and China, Japan, and other countries like Switzerland. They buy our bonds. Why? Because they're safe, guaranteed by the full faith and credit of the US government. Never, ever have they defaulted. 30-year bonds always pay a higher yield than 5 years, right? Because it's a longer duration. It makes sense. So you can see here, the yield was up around 2.6. This is back in 2022. The yields are significantly more now, 5.068 on a 30 and a 5-year. I don't have the 5-year, but we'll just use this. But see what happened here? See how these two things started compressing and coming together? So 3/25/2022, the 5-year T-bill and the 30-year Treasury bill started closing in, and oh no, oh snap, they inverted. You were making less money for a short period of time. You were making less money on a 30-year Treasury bond than you were on a 5-year. That's called an inverted yield curve. Now, back up in history. Go back to World War II, pretty much the first time this started being tracked. Every single time the yield curve is inverted, it is led, and usually it's about a 7 to 9 month time frame. It has resulted in a recession. So if we just started counting right here, 3/27 of 2022, and we say it's a 7 to 9 month lag, when should we be in a recession? Well, you guys can tell we didn't hit one yet. Why? Well, there's a lot of reasons. $5.2 trillion is one of those good reasons, but you can see here, now we're looking at a 2 and a 10-year. Now this one's even crazier. 2-year and 10-year are usually very close, but they also inverted. You see, we've been inverting on the yield curve several times since 2022. Matter of fact, the yield curve right now, still inverted. Let me just tell you, a 3-month, a 6-month, and a 12-month T-bill, Treasury bill, okay? 3-month is 5.45, a 6-month is 5.55. That makes sense, right? You get paid less if you buy a bond for 3 months because you only got to hold it 3 months. Then you'd get paid, less for that than you would holding a bond for 6 months, which is 5.55. But now follow along. It inverts from there on. 12-month bond is only 5.42. A 2-year bond is 5.05. A 10-year bond, this was as of yesterday, a 10-year bond is 4.89%. And a 30-year bond just squeaked up over the 10 at 5.068. If we average all those yields together on 1, 2, 3, 4, 5, 6 different bonds, we get 5.24%. Significantly better than where it was, but not great. I'm simply trying to tell you that the polls, the projections in the surveys on the yield curve say that 62% or 69% chance, 61% chance, I got a lot of numbers here, 61% chance of a yield curve saying that we're going to be in a recession. Then you go on, economists say there's a 48% chance of a recession. Why would economists not be higher? Many of them are employed by the Fed and the government. Of course, they're not going to go against their employer. Consumers, you and I, 69% chance. Goldman Sachs only says 15, but Bank of America says this is a 40% chance. But then when you look at the front line, the leading indicator, which is CEOs of companies, they're saying an 84% chance. Why would they say that? Well, they would say that because they know something that most of us don't know. They know that there's soon going to be a cliff that corporate debt's going off of. And when that debt happens, here's the magnitude of it. So you all know that owning a company, or all of us, we could get interest rates really, really low a couple of years ago. Well, corporations could get interest rates on loans really, really low back then too, on mortgages and on lines of credit and warehouse lines and all sorts of big dollar things. We were 2, 3%. But all of those have a maturity. Some of them were 5 years, some of them were 7 years, some of them were 10 years, depending on when they got it. So here's what happens. When those bonds mature, many of you are real estate investors and you probably know this. You're probably staring down the barrel of a maturity on your commercial mortgages like I am. Most of my mortgages were 5 and 7 year mortgages. So all of my mortgages are coming due. And they're coming due, which means my rate's going from 5% to 8.25%. Now, some of these warehouse lines and these lines of credit businesses have are going from 3 to 8 or 4 to 8. That's a double. It's double in a time when the economy is slowing down, in a time when most companies that are reporting are saying that the economic future is going down, that their expectations of future profits are lower, that their expectations of future sales are lower, but yet their expenses are going to double on their debts. To the tune of, I'll give you the numbers, this should wake you up. 2023, 525 billion matures. 2024, next year, 790 billion matures. 2025, 1.1 trillion matures. And then 2026, 1.2 trillion. Now, do you see why CEOs say 84% of them say that there's going to be a recession? They have this. This is what they're staring down the barrel of. Now, for me, I luckily got off the train. So when my mortgages are coming due, guess what I'm freaking doing? Anyone know what I'm doing? What do you all think that I'm doing when my mortgages are coming due? My money, the majority of my wealth, sits in my private banking system, which are specially designed whole lives. I have 10 of these things, not including my mom's, my daughter's, or my wife's. I have 10 policies, okay? It's not a race to how many policies, but significant amount of money in whole life insurance. So over here is a mortgage on, I'll pick on one that I'm doing. It's a single family rental, and I get $1,300 a month in that rental. It's a real property, Holly. Okay, so this mortgage is going to go from 5%, and it's going to mature at 8.25. Literally in about a month's time, this thing matures at an 8.25 rate. What do you think that does to your monthly payment? Goes up a lot, right? So let's just say, and it's not an expensive house. I think the mortgage on this is maybe 50, I don't know, I'd have to look, but let's just call it 52 grand. If I go from 5 to 825, I'm almost doubling, okay? So if my payment was 700, now it might be 1,300. So let's just use that. Sorry, I don't have the actual numbers. I could pull it up, but let's just say my mortgage is going to be $1,300, okay? So now, do I want to pay Alden State Bank $1,300, or do I want to pay myself $1,300? So over here, I have more than 55, but let's just use $55,000 inside my policies, of which all of them, and if I did it a blended return, let's just say my policies are earning interest and dividends of about 5.5 tax-free. So what I'm going to do is I'm going to take this 55,000, I'm going to then move it over here, and I'm going to pay off their bank, okay? So I'm going to pay off Alden is gone, get rid of them. And I'm going to take this $1,300 that I was going to have to pay Alden, and I'm going to pay it back to myself. Literally. What's difficult about this? Well, the most difficult things for me to do this is I have to call Alden State Bank and get a payoff. Great. They say, all right, your payoff's $52,000. Perfect. Then I take a loan from the policy within 3 days, 36 hours or less. I have 55 grand. I send a check. Okay. So I take a loan from my policy. Just like I took a loan from Alden Bank, my policy charges me 5%. I just want you to all take note of a few things, but then I'm gonna show you something else. So 5.5 minus 5 equals 50 bips. Okay, that's my spread. Just want you to see what's happening here. So I'm making a spread. If I just did the math here from my policy to my loan charge, which is simple interest and this is compound, I make a spread. Got that? All right. So now I'm making money already. Just by taking a loan on the policy, I'm making money. And some of you are probably maybe confused. When I take the 55 grand needed from my policy, do I take my money? Some of you already know the answer. No. I'm the bank, but I'm not going to use my money. Do banks use their own money when they lend you money for a car or for a mortgage? No. So if I'm going to mimic the bank, and the definition of the infinite banking concept is to take back the banking functions in your life, which means I just mimic the bank, but I do it in my banking system. These 10 policies represent my banking system. So when I take the loan from my policy, this 55 grand came from the insurance company's general account. And then on their bookkeeping, what they did is they looked at my death benefit. Let's just call it 800K. It's a lot more, but just simple math. And then they just subtract 55,000 from my death benefit. So if I died the next day after taking a loan, they're only going to pay $745. Why? Because I used 55 of my death benefit. But what that enables me to do is to never stop earning interest in dividends on my $55,000 in cash value. You follow what I'm saying? I'm making interest in dividends on all of my money, but I got to pay 5% on that. This is compounding. This is a flat 5%. I then paid the mortgage off. So what do I say by paying the mortgage off? A couple things. When your mortgage matures or your line of credit matures or any debt you have matures and you redo it with the bank, isn't that like redoing the loan? Yes. There's closing costs. There's a bunch of closing costs, thousands of dollars. So let's just say closing cost on this refinance would be $3,000, which I think it'd be more. I'm just being safe. I no longer have to pay that $3,000 because I'm the bank, and I'm not going to charge myself closing costs. Heck no. I mean, I'm going to be an honest banker. Why would I need to pay closing costs? Why would I need to file a mortgage and pay all those recording fees when it's my money in my bank? But here's what I'm not going to do. I'm not going to steal from my bank. No freaking way am I going to steal from my bank. I'm going to take this $1,300 and folks, here's the thing. You could make this amount any amount. If you used to pay $700, you want to keep paying $700? Great. If you wanted to pay what the bank was going to charge you at $825, which is what I would do, $1,300, I take this $1,300 and I repay the loan to the insurance company. But here's the difference. When I was paying the bank, Alden State Bank, $1,300, did Alden State Bank ever allow me to access that $1,300? Not really, right? The $1,300 was the mortgage payment that went to the bank. I couldn't just call the bank and say, hey, Alden, you know that $1,300 you guys just took? Can I have that back? I need it. My wife's tire just blew out. I need $1,300. They going to say anything? No, they're not going to give you your $1,300 back. But you see, when I pay my bank back, which is just paying the death benefit back, you know, that I borrowed from the insurance company, is that $1,300 available the second it goes into my account? You're darn right it is. I'm the bank. I get that $1,300. So now let's do spread 2. If I charge myself $825, just like Alden was going to charge, what's $825 minus 5%? That is my spread. So it doesn't matter whether you do the spread on this side of the equation or this side, it's still money in your pocket. But not only that, I didn't have closing costs. I get to control all my money and my money never stopped working for me. So this is what I'm doing. I'm just repaying the debts, but I'm doing it with my banking system. I'm becoming my own bank. So I just wanted to draw that for you really quick, but let's keep moving through this. There's a couple other really important things. So remember we talked about the debt and we talked about CEOs saying there's an 84% chance of a recession. That's why they know. But let's go into another thing. This right here represents, it's an ETF that represents treasury bonds, okay? This is TLT. It's an ETF of 20 plus year treasury bonds that I buy a lot. I want you to look at a couple things. If we go back to 2008 and 9, that was the Great Recession. Do you see what happened here? The price of the bonds skyrocketed. Did you all see that right here? Bonds skyrocketed. They went super high. Why did they do that? Well, what happened when the Great Recession hit? The Fed pulled rates to close to zero, right? Okay, so the bonds were cheap, but then they were really expensive really fast. 2011, who can tell me what happened in 2011? The Fed started trying to change or to increase started trying to raise rates after the Great Recession right here. And then we had the Euro debt crisis, right? The sovereign debt crisis over in Greece and, well, the whole European nations. And that sent shockwaves through. So they pulled rates again, which raised bonds up again. But here again, just look over here. This right here, this is during the pandemic. What happened when the pandemic hit and the world shut down? The Fed dropped interest rates. Every government dropped interest rates. What happened to treasury bonds? They skyrocketed. When interest rates go down, the price of bonds goes up. And when interest rates go up, the price of bonds goes down, represented by this steep decline. This is the Fed's action over the last year and a couple months, creating an incredible buying opportunity, which I'm going to cover more about and how to do this on Friday. Okay, I just want to show you this because this spells, this is telling you the story. It's all I'm trying to do is I'm trying to paint the story of what's about to happen. And this weekend at the 3-day, I'm going to give you all the tools. I'm going to show you exactly how this works. But there's one other one I wanted to show you. And this is pretty interesting because remember that drawing I just did a second ago? I want to do one more thing, okay? I want to show you, you'll see a YouTube video of this and I'll cover a little bit of this Friday, but not much. But This is a Porsche that I just bought, okay? I'm not bragging. It's a 1997 Porsche 911. It's the 993, last of the air cools. That's all you need to know. I bought it on Bring a Trailer for roughly about 75,000 bucks. So if I wanted to buy this car, or any of you wanted to buy this car, how would you buy it? You could pay cash, right? A lot of people would pay cash. So if you paid cash for this Porsche, that 75 grand is gone forever. You never, ever, ever, ever can get that 75 grand back. So let's just, this is something a lot of people probably don't do that I want to show you. What is the future value of 75 grand? Can you guys all see that calculator right here? So if we just do this and we just say 75 grand, and how much, you know, in a bank account, a money market, or a policy, I think 5% is a good rate of return. So I'm going to use 5%, and I'm just going to put 30 years. So how much is $75,000 worth at 5% compounding for 30 years? $336,092.15. But hey, we can just look at any year. You can go in here. So year 2, how much is it worth? 87,000. Year 3 is 87. Year 4, 91. Okay, 96. You guys can all do this. This website that I'm on right here is investor.gov. It's a compounding interest calculator. I'm trying to show you that this is the mistakes people make every single day that you don't have to make anymore. This is just a stinking car. If you pay cash for a car, you gave up the opportunity to earn money on $75,000 in this Porsche example. Okay, but we're going to come back to this in just a second. Just trying to show you that's what you give up, and you can play with that and do that calculator and look at it. I just want to get through this quickly because I'm trying to give you as much value as I can. What I did is you could pay cash, but you could also finance it. So when I did this, I called credit union here. It's Cornerstone Community Credit Union. It's one of the best for borrowing money for cars. They love car loans. And I used to always use Cornerstone Federal Credit Union to get loans for all the cars that I used to buy. I used to love Audis. So when I got this car, or I locked this car up in a bid, okay, I called them up and I said, hey, Cornerstone, what is your best rate? And you know what they said? They said their best rate was 6.8, which actually was a really freaking good rate. Everywhere else was like over 7. Today, you'd pay 8%, over 8% for this used car loan. But when I bought this car, it was 6.8. So if I did the math and I ran a calculator, which the bank can do for you as well, for a 5-year loan at 6.8, my monthly payment's $1,478. Okay, following me? $1,478 would be the amount of a monthly payment for this Porsche, for a $75,000 Porsche. If you did that and you paid for your car like a good borrower, for every one of you are good borrowers, you always pay your loans back, right? Right? But if you did that, you would have paid $13,681 in interest to Cornerstone Federal Credit Union or any bank, okay? And that's less than what you'd be able to do it today. Today it'd be 8%. The total cost of that car wasn't 75 grand, it was 88,681 if you financed it. So hold on, let me bring you back. I'm just trying to get you to start seeing what's really going on out there. I want to show you one more thing because I think I did this the other day and this really woke me up. Remember that calculator we were doing? Okay, so if you just gave up just the interest, $13,681. We just did the interest, okay? Let's just say that $13,681, you didn't ever have to make that payment to the Cornerstone Credit Union, and you got to keep that money and it just sat in a bank account in one of these specially designed whole lives and earned interest. How much is that worth? $61,000, okay? If we go to year 2, it's worth 15, okay? 13 turns into 15, 13 turns into 16 in 4 years. See what's happening here, folks? 18, 19, I mean, come on, we could play this game all day long. 28, 30, that's your opportunity cost. That's what you're giving up when you finance a car through a traditional bank, especially at these interest rates. So what's the alternative? It's simple. It's so simple. There's nothing complicated about what I'm about to show you. So every one of you should pick this up just like this. And if you don't, I want to ask all of you as we're doing this to put it in the chat. I want you to put any questions in, not the chat, I'm sorry, the Q&A. I want it all in the Q&A. So here we go. What if, just what if, all I did is I changed where the $75,000 went first. I took it out of the traditional bank and I put it into that specially designed whole life insurance policy. That's it. And then everything else is the same. Then I took the 75 and I bought the car. What would that look like? Let me show you. You guys are starting to get used to this. So I changed one thing. I put the 75,000 in a whole life. Now, what I'm going to show you are real numbers from one of my older policies. I've had this policy for 3 years. It's a little bit older. So I actually had there's 80 some thousand bucks. But let's just say that policy was paying me 6% with dividends. I take 75,000 out at 5%. There's your spread one. Okay, got it? I pay for the car. I already knew Cornerstone would have charged me $1,478. So I go in my bill pay and I set up a monthly bill pay or monthly bill payment, piece of cake, for $1,478. In the memo, I write 1997 Porsche loan payment. And every month that $1,478 is paid back to me. SA stands for segregated account. It's just a bank account. I take the $1,478 and I put it back in my policy every single month. Just round and round we go, right? The best way for you to make and build wealth is to take back the banking functions, is to stop giving money away, stop the leakage. I'm creating a circle that I fully control, and I still get all the things I want. I give nothing up, absolutely nothing up. I didn't give my money up, hell no. I didn't give control of my money up, oh no. I didn't give anything up. Matter of fact, I gained a better interest rate in a tax-free environment. I gained a death benefit in this particular policy of $903,000. Sure, when I took $75,000 out, my death benefit drops by 75 grand. But hey, I don't plan on dying today. If I keep driving this car the way I am, well, that's probably looking a little bit more probable, but don't tell the actuaries. The underwriters don't need to know about that. So I pay that money back. But remember, I would have borrowed from a bank at 6.8%. So 6.8 minus the 5% is 1.8. That's spread number two. This is where most people would stop. Okay. This is where most people would look at it and they would stop. They'd be like, okay, well, that's my spread. Wrong. That's not your spread. Folks, hopefully this is making sense to you. And if it's not, I need to know.
You ever feel like you don't have control of your real estate business or your money? That's right. The big banks and the institutions, they're in control, right? I know you felt that before. Private Money Club puts you back in the driver's seat. As members often tell us, it's a total game changer. Join the community of like-minded lenders and borrowers by going to privatemoneyclub.com and sign up.
I know I'm going fast, but I only have a little bit of time with you tonight, folks. So we're 30 minutes in, and I've covered a lot of ground, but I went quick. If you want more, like I just don't have enough time tonight, and I know you all agreed with me earlier, so join me for the 3-day, I'm going to deep dive, but I'm going to go into something I've never shown before. This stuff that we're going into, this is like when you sit down at the theater and you're just watching the previews. You're like, when the hell's the movie going to start? The movie starts Friday morning at 10 a.m. Eastern. Get in the game. $197. You don't want it? You don't want to join? You don't want to do it? Take the free hat and I'll give you your money back. Just register. It's action that matters to me. It's not the people saying, oh, well, I don't know. I got this wedding. I got to watch the game. Just take action. Just take action. You'll get a free hat delivered to your house. And I guaranteed that if you didn't like something, if you don't use it, I'll give you your money back. Just ask for it. Email me, contact@chrisnaugle.com. No one else does that. It's because I'm not doing this because I want your money. I'm doing this because I want your freaking commitment, because I want you to change your life. Let me show you another way that this changes your life. The one thing you all didn't pick up, or some of you maybe did, but what I was going through there in that system called the infinite banking concept, you all, because I fed it to you, I tricked you. I gave you the numbers. 6 minus 5 is what? 1%. You're all like, oh, Chris is making 1% on the policy, but that's gross. And then after cost of insurance, it's less. And then on the other side, you're like 6.8 minus 5. Okay, Chris is making 1.8. Wrong. You got to remember, 75 grand never left my policy. It's still in cash value, still earning 6%, compounding over and over again. And then on the other side, the loan I took from the insurance company, what am I doing? I'm paying it down by the rate of $1,478 every single month. Take a look over here. This is a quick snapshot of exactly what I'm talking about. And this isn't using the same one, but we'll be showing this. But this is if I took a $10,000 loan and I paid the loan back $524. I just want you to look over here. Does anyone see 5%? Wait a second. What, doesn't the insurance company charge you 5%? Yeah. They charge you 5% on the remaining balance. So if I started with 10 grand and I paid it down by 524, my remaining balance is 94.78, which means my APR, the rate that I'm actually paying, is 4.738. So what's 6 minus 4.738? More than 6 minus 5, right? And then see, just follow this down. This is month by month. I only did 2 years here. But look at this. By the second year, am I paying the insurance company 5%? I am. But I'm paying them 5% on 3,518, not 10,000 in this example. So what does that mean? That means I'm only giving them 3.1, and on down we go. Folks, that's a quick snapshot. We got tools that do this for everybody, but what did you just learn there? What did you just learn? You learn something that no one will teach you. You learn something the bank will never tell you, that it's not always what you see on the front line. You think you got a cheap mortgage because you got a 30-year mortgage fixed at 2.8%. I'll tell you got the most expensive mortgage ever because you're not looking at the right things. You're just looking at the face value. When you're looking at this and you're saying, wait a second, let's flip that. Let's say the loan from the insurance company was 6 and the insurance company paid me 5. All of you would be like, that's idiotic. The insurance company is charging more than what you're actually making. You're a fool, Chris. Wrong. Because of what I just showed you, you're paying the loan down because of the infinite banking concept. So every single month, you're making more money by sheer mathematics and the velocity of interest. But that's not the numbers. The numbers are positive today, right out of the hole. Let me prove it. So all of you can see this. This is my actual policy that I was talking about. $30,000 in premiums I put into that policy that I bought 3 years ago. Okay. It's 3 years old. So I'm 46 today. Okay. Here's the cash value. I have $87,970. This is a couple days old, but my cash value growth for the third year, if I took year 2 and subtracted year 3's cash value, I made $30,896. What do you all see? I put 30 in, I made $30,896, which means I made $896. Great. That's a 2.99% return on my money, cash on cash. That's terrible, right? That's what you're thinking. But wait a second. If I die, my family gets 900 and some thousand bucks. Let's go on. Year 3 to 4, it grows from 87 to 119. I made 31,716. I made $1,716. Folks, this is net. Dave Ramsey, oh, it's so freaking expensive. Whole life is the most expensive thing. And Susie Orman's like, oh, yeah, it is. It's the most expensive thing that there is. Hold on, Dave and Susie. Let me put my glasses on. Now, hold on a second, Dave and Susie. I just put 30,000 bucks into my stupid whole life, that thing you told me not to. And by the math, the guarantees, I made 1,716. And if I divide 1,716, my net gain, net of commissions, net of policy service fees, net of cost of insurance, all those things Dave said were really expensive. And Susie was like, yeah, they're really expensive. I made 1,716 bucks. If I divide that into 30 grand, the money I put in, folks, I made 5.72%. That's 72 bips above the loan interest rate. So you can see here, I'm counting it down. Here's the loan balance going down, and here's the spread I made. I made 2 spreads, spread 1, spread 2. I didn't cover these columns yet, but just look. Year 4 to 5, I made 33. That's $3,028. That's 10.09%. I made a spread of 5.09. Do you see what I'm trying to say? This is compounding interest. This is just math. I'm showing you actual numbers off my illustration. There's no hypothetical here at all. This is the policy, folks. This is what being your own bank does. And I'm only giving you half of the picture right now. So if we tally up the 5 years, I would use this policy to buy that car. 5 years. I started at 87. I got 218 in the 7th year, okay, when I'm 50 years old. The car's paid off, okay? I made $33,609 on the 30 I put in. I printed $3,609. Yeah, the Fed and the Treasury should eat their heart out. Not really. They can print money out of thin air, but I can print money too. It's called compound interest. So that's a 12.03% cash on cash return. That's 7% more than what the insurance company charged me that year on the interest for that loan, right? But hold on, it gets better. I'm paying the loan balance down because I'm being an honest banker. If I'm going to pay Cornerstone Credit Union, why wouldn't I just pay myself? So hell, I'm going to pay myself $1,478 a month. I didn't lose anything. It's kind of almost just silly to even say. I bill pay $1,478 into my policy. I have now $1,478 in my policy to use the next day if I need it. What changed? I didn't let the bank hold my money. I put it back into my policy. But when I put it back in my policy, what did I do? Didn't give up liquidity. Didn't do anything. I literally paid the loan balance down. So there's this. So this car doesn't take me 60 months to pay off. It takes me 57. Why? Because the insurance company only charges me 5% when the bank was going to charge me 6.8. So I'm calculating 6.8 because if that's what the bank's going to charge me, well, why wouldn't I pay my bank back the same exact amount if I get all the money? I mean, it's just kind of just numbers on the screen, right? We'll just move them around. What do we want it to be? I don't know. 10%? Sure. Doesn't matter. As long as you got the cash flow to do it, you can do it. So then if I just take the spread, so let me explain this column. I did the spread from 6.8 to 5%. The amount over what the bank would, or over what the insurance company charged me. It's not a lot. 1433, 1234, 1017, 768, and 437. Total spread, 4,889. But now, drum roll, please. Terrible. This is where it gets interesting. If I add up my cash on cash, net return, the stuff that Dave Ramsey said doesn't exist, because those whole lives, they're just overpriced, high commission, pieces of garbage, whole life policies. Like, you should never buy one of those. Okay, Dave, 5 years, I bought a car. I made $11,186. Okay. Plus, Dave, I got all my money back for the car, dude. I literally got $75,000 back because I put the payments back to my policy. I got my money back, Dave. The car, all the money for the car is back, and the car's in my driveway. Dude, it's Christmas all over again. Santa brought me a new Porsche. It's in the driveway. It looks just like the old one that you said that, like, I'd have to trade in and sell to get my money back. It's not, it's in the driveway. Plus, I made $11,186. But then I made the spread over here. If we add that in, that's $48.89. So literally, I got all the money back for that Porsche. And that Porsche, I made $16,075. You can't make this shit up. That's just the math. I made $16,000 for buying that car. I literally made $16,000. I'm just trying to get this to sink in, folks. I made $16,000 for buying this car. And of course, technology is going to fail me. That video is coming soon to YouTube. You'll be able to see the whole video about that car and everything else. So, all right. So this weekend, we're not going to learn how to buy cars. Okay, we're not, because you just learned that. Now I don't need to do that this weekend. What are you going to learn? You're going to learn how to make a risk-free return using the exact same strategy I just taught you. What else are you going to learn? You're going to learn how to apply it. You're going to learn how to do it. You're going to actually be shown step by step how to do that. Because if Treasury bonds right now, the 3-month, 6-month, 12-month, 2-year, 10-year, 30-year, averaged out pays 5.24, do you see where I'm coming? Risk-free. That's your yield on Treasury bonds. Why are you still in the markets? Why are you taking risk in your money? You could be making money twice on the same dollar with no risk. But that's not the whole story. You see, the one thing, and I'm going to bring this all together right here, right now. Got to get another screen, because listen, a picture is worth 1,000 words. And I'm spitting out 1,000 words trying to get as much done. I keep looking at that clock. I'm looking at your questions. So please keep your questions coming in. And if you think you're too old at 66 and a half, how many of anyone here that is in the chat that's already around the campfire, that has a policy, that you're around 66? How's the infinite banking concept working for you? So anonymous, I'm 66 and a half years old. You know, I've been told I'm too old for this. I'll let everybody else do the work. Okay. So Treasury bonds, because of the Fed raising rates, it doesn't matter which one you use. They're all going to be good. I buy a bunch of them. I have a diversified portfolio of T-bills and Treasury bonds, as you should too. You know, why buy one when you can have more than one and you can diversify your risk by duration? 5.24. Just hear that out. 5.24. I just changed this today. We know the Fed's been raising rates. And because the Fed's been raising rates, the price of your Treasury bonds have gone down, down, and down. So right now, I can't tell you we're at the bottom, but we're pretty freaking close. Jerome Powell held rates again, but said there might be one more rate increase. He doesn't know. He's got to play it by the data. But let's just say there's one more rate, which means you're super close to the bottom. You can't get the bottom. What's going to happen in the future? So if you can buy Treasury bonds at rock bottom prices, may I remind you, because I know people come in and out of this training, here's what I mean by rock bottom pricing. Okay, so all of you are looking at the same thing I'm looking at here, and you can see the pricing. Look at that. That's pretty much as low as it goes. It's like limbo. Okay, you guys have all played limbo. It's like as low as it goes right there. I mean, there's a couple of periods of time where it got close, but that was 2007, folks. What came after 2007? Do I have to remind anyone? The Great Recession. We are at those levels right now. So what happens next? Well, future is a good indicator. I just wanted to point out that when something's low, buy low, don't buy high. If you're buying S&P 500, Dow Jones, or any stock that your advisor is telling you about, or mutual fund, you're buying high, guaranteed. There's no value out there in the stock market. I'm telling you that right now. I could look through thousands of stocks and mutual funds and ETFs, and I will tell you, if they're all index or stock-based or equity-based, there's probably no value out there. You're speculating on all of it. But here, you can buy Treasury bonds that are guaranteed by the full faith and credit at almost the bare buy. It's like Walmart rolled their prices back over and over again to get to this price. And then what's going to happen? Well, according to CEOs, according to economists, according to the yield curve, according to consumers, a recession's coming next. Maybe a world war, maybe not, but let's just start with the recession. And what happens every recession? When we go into a recession, who can tell me what happens? What does the Fed do when we are in a recession? What does the Fed do? Print, baby, print. But what do they do while they're printing money? That's correct, James. What else do they do? Oh, Jeff said it, lower rates. Every time, it's like clockwork. So two things happen because the Fed controls monetary policy. We go into a recession. Oh my God, everybody's hurting, everybody's losing their jobs. I'm not making fun of this. It's a bad scenario, and it's going to happen. Everybody's losing, and the government says, oh my God, we got to help everybody. And the Fed says, oh, we're going to help everybody. What do? They drop interest rates. Then what do? Turn the printing press on. They print a bunch of money. See, here's the problem though. They really never stopped printing money. Like unprecedented, they're going to print almost $1 trillion this last quarter. Where's it going? Not on our soil. Ship it off. Now, I'm not saying that's good, bad, or indifferent. I'm just saying they're printing money still, and they'll print more, but they're not going to print more for us until they get inflation to 2%. They're just going to ship it overseas. They're going to basically aid two wars. Okay, dude is playing proxy war right now on two different landscapes. Anyway, you can figure out who the dude is. All right. So when we enter a recession, you guys said it. They're going to pull interest rates. And what happens every time they pull interest rates to your treasury bonds? They go up. Do I need to remind you what that means for you? If you do what I'm going to teach you Friday, you're all going to make a lot of money. You're all going to make a lot of money risk-free. You don't need to be good at this. You don't need to time this. You don't even need to time it right. You just need to watch. You're going to see it on the news. The Fed raises rates. You just go into your account. Oh, okay, we're up. Okay, the Fed raises rate or drops rates. Sorry, I said raise it. They're going to drop rates. You hear about them dropping rates. But see, when they raise rates, they do it slowly because it hurts us. It hurts everybody when they raise rates, including the United States government. Matter of fact, if I have this will blow your mind. So the United States right now owes 33 trillion. It's probably more today. This is old. And for every 1% that the Fed increases interest rates, it costs the United States $320 billion more in interest. Every 1% increase that the Fed does costs the United States government, the entity, $320 billion. So they raised rates 5 times, but I can do it by 3 because it's simple math. A 3% increase in interest rates costs the government $1 trillion. Okay, put that into perspective. So if you think the US government wants the Fed to drop rates, well, you bet your butt they do. I mean, why not save $1 trillion here and $1 trillion there? I mean, come on, 3%, come on, trim the fat and keep it off. $1 trillion. Cool, right? That's when you make a bunch of money. Everything is in your favor. Everything is pushing you toward this result. It can't happen any other way, but you're going to do it in such of a fashion where you're going to make money twice. If you're seeing what I'm going to cover, because I've already laid it out, I just didn't tell you yet, take the Porsche, take the treasury bonds, melt them together, make a magic potion, and now you got yourself a protein shake, and that protein shake will make you big and strong, but not you. It'll make your wallet big and strong. It's like Fat Wallet, that one video we did. When I have an hour, I just don't have enough time to get it all out, which is why you got to join me. It's not an option. You just got to join me this weekend. And if you can't join me this weekend because you got obligations, just freaking watch. Just pay the $197 today because we're giving you $100 off plus the hat. Shows up to your doorstep. Pay the $197 and just watch Fridays. At the end of Friday, Cole Snell comes in teaching you the future of IBC when it is taken to the blockchain. Saturday, we got a bunch of great speakers. Sunday, opportunity, opportunity, opportunity. You don't want treasury bonds? You don't want that strategy? Great. You're going to have 3 more. You're going to hear from a hedge fund. You're going to hear from some of our borrowers on Private Money Club. You're going to hear from the Fullers. We got so much stuff planned this weekend. I can't even remember it all. I literally have to go up here and I have to look at all the crap we have because I'm so caught up in my own head on what's going to be happening. So this is the website right here. That's the link Shauna keeps putting up, moneyschooltraining.com/registration. You just register and reserve your seat. You just hit that button. Okay, it's going to come up and it's going to say it's going to cost you $297 when you put that info in, but you're going to go in and you're going to put that little code in and it is final. Whoops, hit the wrong button.
Yep, you got to go up more in the page and it's keep going up a little bit up. It says have a coupon, click here to enter your code. Yep.
There we go. Thank you. FINAL 23. That's your coupon code. Apply coupon. $197. The hat's an automatic, folks. As long as we got your address, you notice we do ask for your address. Some of you are like, why do they want my address? So we can mail you a hat, silly. Okay. We want to mail you a hat. But then when you come down here, $197 plus a hat. What are you going to learn? There's all the speakers. Okay. Day one, you guys get the drift. There's a bunch of stuff, but day 3, Sunday, we're going to hit a ton of opportunities. We're going to pave the way on how you protect your assets, how you become very risk averse with your assets going into what will be the next recession. Hopefully not the next world war. Hopefully not the next civil war. Hopefully just a recession. That's the best case scenario we can get. That's the best outcome. We just hit a recession. And with what I'm going to teach you, you're going to make a ton of money when all your friends, family, and coworkers that didn't show up to the 3-day because they're not part of the 5%. Actually, if you show up to the 3-day, you're part of the 1%ers, not the 5%ers. By you being here tonight, you're the 5%ers. By you actually committing and taking action to join us Friday, Saturday, Sunday, this weekend, you're the 1%. The 1%. And the 1%'s a reward, a really cool reward to have.
So Marlon is asking, is the policy in a trust or no?
Good question, Marlon. It can be either. So I have policies that are owned in my personal name. I have policies that are owned in my company's name, Money School. And then I also have policies owned in my family trust. In the future, all of my policies I will basically have in my trust structure. But if you don't have a complex trust structure and you don't need a complex trust structure, just own them personally. The trust provides protection and it provides asset protection. But I want you to all know that the policy, any money in the policy is protected against judgments and liens in most states in this country. You can look it up. What states is life insurance protected against judgments and liens? And it'll spit out all the states, almost every one. But there's a couple that it's been tested in. And the only way that you lose, okay, is if they can prove that you were literally, I don't want to say money laundering, but you were trying to hide assets. But anyway, it's protected against judgments and liens. So if you're thinking about, oh, I need a trust before I do the policy, you're wrong. Do the policy. And later, when you're ready for the trust, when the trust solves a problem for you, trusts are being thrown around in all the wrong ways these days. Like trusts are being sold to people that don't need trust. And anybody that's a CPA or an attorney on here, you'll agree there's too many loose cannons out there selling trust to people that don't need trust. And if you get a trust, guess what that means? You got yourself a new tax return at the end of the year. Don't miss that. So I would say just do the policy in your name. And when you're ready for the trust, change the ownership and the beneficiary at the time when you're ready. Okay. So don't wait for the trust. Just do the policy and then change ownership later. Great question.
Couldn't agree more. It's definitely a fancy buzzword that most of us don't need to really learn about. Laura's asking, what if you can't get whole life?
So if you can't get whole life, you mean because of if you can't get life insurance? Because if you can't get whole life, you can't get term, you can't get IULs, and we do not use IULs. I just saw somebody put that swear word up there. They are the imaginary unicorn life. That's what we call them. I don't have time to get into IULs. Let's see. So if you can't get it on yourself because of a medical reason, we deal with this every single day. What we do is we basically figure out, do you have a significant other? Okay. Do you have a child? Do you have a business partner or a key executive in your operations in your company? They could be the insured and you could be the owner. See, in ownership comes control. So as long as you own the policy, you control the cash value. So if you are uninsurable and you cannot be the insured, we just got to find a body to ensure that you have an insurable interest on, like those people I mentioned. We do that every day.
We'll just do a couple more. We won't get into IULs because this is not what we're talking about.
I could get into it, but you're going to have to stick with me for another hour and my wife is going to be pissed at you.
Right. Randy asked, he recently watched the YouTube video, Designing a Policy for Maximum Cash Value, updated about 5 months ago. The question is, do you measure efficiency by year-over-year amount divided by the premium deposit amount for the year? And if so, seems likely higher PUA is more efficient. 60-40 ends up lower returns by percentage, ?
That's a great question. You can measure it either way. So remember, all we do here is the infinite banking concept, which means we're putting money into the policy and we're immediately taking that money out. So when you're looking at the efficiency of the policy, we do measure it by a cash on cash return because we're assuming that any money that goes into the policy, we're going to send it out to work a second time. So really the only number that really factors is the new money that goes in the policy, right? The new premium deposit that you put in year after year. The existing premium deposit you put in, which would make up a cumulative return, that money's already out working. So that's the way we look at the efficiency. So what you're saying is when you're looking at the different designs, you're saying, okay, 60-40 ends up with a lower return. Yes and no. Somehow you miss something there because the base, which is the most efficient long-term, does have a higher return. But I can't, who was that asked that question, Sean, or you canceled it?
Randy.
Randy.
But another point is you're dismissing everything that you could be doing with the money out. Like everything you could learn at the 3-day also would increase any sort of return as well, because that's just policy returns.
Yeah, but let me give him the answer. So, for most people, a higher early cash value policy for their first policy is going to be the best. Now, my first policy that I did for IBC was a 60-40 because that was just all we knew about back then. We've gotten really elaborate in plan designs and doing, the Slayer, the Beast, the Rock, the 90-10s. Each of them are good in their own realm. The 90-10, which is kind of the swear word, but I do use them, only works if there's no dumping. Because if you dump it in, you're redlining all of the term. And we don't like keeping term on longer than 10 years because it becomes less efficient, especially if you're older, because term gets more expensive as you get older. So for most people, the higher early cash value plans are going to be more suitable for their first policy because we can get that money out to pay off debt, buy cars, loan out on private money club. So when you're looking at efficiency, that's usually going to be your most efficient option. But as you start building your banking system, please don't forget about the 60-40s because they are going to be your best bang for your buck. I can show you the returns. It was in the video. The returns on the cash value are better on the base than they are the PUA in the long run. Plus, the base gives you the ability to put more money in for a longer period of time, so you don't have to keep opening new policies, restarting the curve. Sorry, long answer.
Since we're already just about 5 minutes over, I'm going to say one other thing. So not just the 3-day coming up, I'm going to put the 90-minute webinar in the chat, as well as how to book with a money mentor. We give you the 90-minute as a prerequisite, so you can make an informed decision if this is for you. You can learn all the ins and outs about it. You can do that today. You don't have to join the 3-day for that. That's just in addition to, I'll put that in the chat too for anybody who's interested in this vehicle alone. And if you may not come to the 3-day, but I think we probably can wrap with that. I'll put the 3-day back up there and just how to book with a money mentor as well. Gold Tran said, which I thought this was interesting too. He said, I recently took out a loan and they didn't give me the full cash value. The guy I'm in contact with says that that One America takes out the interest ahead of time. Can you elaborate on how that works? If they already took it out at the start, does that mean paying down the loan won't make a difference?
Gold, my guess is that you spoke to somebody at One America, right? They didn't really know what you were asking, so they didn't really give you the right answer. That's not really what happens. So essentially, you hear me say this all the time. Most insurance companies will allow you to take 90% of your cash value. So what about that other 10%? Well, that 10% is still in there. It's not going anywhere. It's why all the calculations we usually do will have a 10% residual left over. We never take all of the cash value out because we can't. It's the insurance company making sure your policy isn't going to lapse, because the insurance company, the way they calculate the cost of insurance, depending on the premium mode, basically requires some cash value to make it work. So usually they're going to keep a reserve in there. It works out to be, some is a little less, some is a little more, but it's about 10%. So when you took the loan, Gold, you probably had to leave about 10% in there. They said it was to keep the interest. Not really. Maybe that's what they were thinking. It's just a reserve to keep the cost of insurance in line so your policy doesn't ever have a chance of lapsing. It's basically just an it's like an anti-theft for your car, but it's an anti-lapse for your policy. It's a safe haven. Okay. Your money's still earning. You just can't use all of it. We cover that on almost every training we do.
Anonymous said, hey, Chris, I have a VUL that made very little cash over a long time. Should I be rolling it over to a whole life policy as a dump in? What benefit would it be to keep the VUL? My death benefit is $250,000. So is that worth it to keep it?
Anonymous, this is very near and dear to my heart. I don't know if you've ever heard me talk about it, but I talk about it often. I even have YouTube videos on this at the Chris Naugle's YouTube channel. I owned a VUL as well. When I was an advisor, my first company I worked for was New York Life and Nile Life Securities. I was a registered rep. So one of the second policy I ever bought was a VUL because they were sexy. Oh my God, I get to buy term and invest the difference in the same tax-free wrapper. Sign me up. So I was putting money into that VUL and things were going a little bit until you read the prospectus. So Anonymous, it's that giant thing that used to come in the mail that you never read, that you started fires with. That was your prospectus. That had all the fees and expenses of your VUL. They're high. very high. The management fees, 12B1 fees, the separate account fees, just all of it, very high in a VUL, which is why you've made very little money. I got rid of my VUL, okay? But I waited, and kind of like you've had that for a while. I waited till after I was out of the surrender period, because all VULs have a surrender period. Your cost of insurance in your VUL will keep getting more expensive the older you get. So that $250,000 death benefit next year will cost you more, the year after will cost you more. But guess what's not going to happen next year? Your market, the separate account with all those mutual funds, is likely going to go negative, which is going to be a drawdown on your cash value. And eventually they get flipped upside down. In 2008, I almost lost mine. I had less cash value than I had cost of insurance. The insurance company, New York Life, sent me a letter saying you got to put more premium in. I said, I can't. We're in a recession. I don't have more money. Luckily, they kind of did this thing where we got to pause and go through. So what's the benefit of you keeping the VUL? I would say if you're still insurable, little to none. What you should do is a 1031 exchange, and we're happy to review this. And here's the one thing. Any of you that have an old VUL, an old IUL, or an old universal life, and you're looking at, what is the viable thing to do with this? We have calculators that Craig has created that will literally show you mathematically side by side if it makes sense to do a 1031 exchange of your VUL into a specially designed whole life. And if it doesn't, we won't do it for you. Okay. It's just not suitable for what you're doing. So let us do that. Shauna put the link in there.
Yep. David and Dorothy said, hi, Chris, can you kindly comment to the audience on how to deal with passive real estate investments in a turning economy? Is there a strategy change? So passive real estate investments, probably as from the lender's point of view.
Yeah, so great question. So they're probably referring to, like, if you're going to be a lender, a private lender on Private Money Club, what should you be looking out for into these coming years? Because obviously we're talking about a recession, but a recession also hits real estate. It's already happening now. Median prices are coming down. Builders are getting really creative, like it's weakening, and pricing is going to continue to go down. So if you're lending on an asset, okay, to a borrower, and you're lending at today's value, it's a good chance that in the future the value is going to be lower, which isn't good for you if you're lending 100% or 90%. So just take one from the banks. Here's how I do it. When I'm underwriting a deal, I'm looking at what the current value is, and I'm subtracting anywhere between, depending on where it is in the country, anywhere between 10 and as much as 25% off the value. So the after rehab value, let's say it's 300, I'm discounting it down by 20 or 30%. And I want to see what is that, and I'll lend on that. So LTV, loan to value, is what they typically would call that. Reduce your loan to value on what you're lending, or lend on properties like for example, the Fullers is a great example. Ground up development, where they're adding value every stone they put in the ground, they're adding value to it. So that's your safest bet. Either lend on something that has massive appreciation that's going in because of what they're doing, or significantly reduce your LTV, or another thing, take one from the Fullers, get a personal guarantee to cover the shortfall, or get a cross collateralization. Somebody that's borrowing for one property probably has others. Get them to cross collateralize it if they want you to lend a higher LTV than what you want. Say, okay, I'll do that, but you've got to collateralize it with a bank account, with a brokerage account, with this other property, or your you know what I like doing? I'm kind of a jerk. Are you willing to cross collateralize this deal with your primary residence? You know why? Because I know they're not going to put their family out on the street. I know they're not going to want to go to their wife or their husband and say, hey, honey, I lost the house. Yeah, we didn't pay that borrower that lent us that money. I know I should have. Yeah, they're foreclosing on our house. Yeah, so me, little Johnny, we got to find another place to live. They don't want that. They're not going to. So I know it sounds dirty, and some of you are like, you scumbag. Listen, I'm in the business of lending, and I'm also in the business of teaching people how to protect their wealth. So you can love or hate it. Doesn't make a difference. It's smart business.
Okay. Mike is asking, is it beneficial to pay back policy loans in one lump sum, or shall they be paid back monthly over time?
Mike, it really depends on your scenario and what you're doing. I rarely ever pay policies back in a lump sum unless, like, I got a big bonus or I got a big windfall of money and I'm sitting on a bunch of money and I don't know what to do with it. Then I might pay the loans down in a chunk until I find another opportunity to redeploy those funds. Otherwise, my strategy is very simple. You saw me do it with the car. That's how I do it with copy machines. That's how I do it with loans to my companies. That's how I do it with loans to private or to borrowers on real estate. That's how I do it with everything. It's monthly. And I just take that monthly income and I just roll it back in as loan repayments. And as it builds up, I send it back out to work. And as I put new premium deposits in, I send it back out to work. It just keeps perpetuating the end result, which is more passive income coming back through your banking system. And at some point, like, hey, maybe you got enough passive income coming back, you can start living off of some of it. For me, my income that I live off of comes from me doing things like this and just going out and doing the grind, right? But someday I'll turn and I'll say, okay, look at all this passive income. How much do we need to live? And we'll live on that. Great
Perfect.
question.
We got 3 really good questions left. Marianne is saying, I'm 76 years old, single, no living relatives. What should I do? Is the 3-day any value for me?
Holy crap, is it ever? Yeah. So forget about the banking stuff, okay? Because at 76, we're not going to be able to make, well, I don't want to say we're not going to make the infinite banking concept work for you at 76. We're just not going to be able to do a policy on you. It's I never say this, but when we say, somebody said that whole life, I'm too old for it. Well, at 76, it's just not going to be an effective strategy for building wealth. It'd be a great death benefit strategy, but not building wealth. But Marion, like really your benefit of coming to the 3-day is on a whole different level of protecting your wealth, but also the legacy play. So, at 76, and I can't tell you what you are or are not doing, but you might be thinking of like legacy. You might be thinking of your family and how do I maximize everything I'm doing today and everything I've built up to this point so that that legacy is going to be there, but also how do I maximize it so that I can live a better life for the years that I'm still here, right? So that's the goal. We're going to show you how to maximize that listen, at 76, or even the next one, Richard, at 72. I'm going to cover you both, Marion and Richard. Both of you got no time for a correction. You got no time to lose money. And I'm sorry. I'm not trying to be negative. I'm not trying to be kind of rude. I'm trying not to come off that way, but you can't lose money right now. You'll never make it back. You don't have time that will ever allow you to make it back. The drawdown effect will eat you alive. The withdrawal and the drawdown effect will eat you alive and eat your wealth alive. This next wave, you got to be on the right side of it. I can't stress it enough. I mean, a 20, 30-year-old, can they weather the storm? Maybe even a 40-year-old? Yeah. Can you? No. So that's why you need to be at the 3-day.
I couldn't agree more. And honestly, there's so much opportunities for you and for any of the dollars that you have, and a lot of support within our community too. So yeah. I definitely highly suggest.
And then Richard, the other thing, like you got 50K cash and you want to buy a car. Okay. Would IBC be the best solution? 1000%. Even without the policy, infinite banking, just the process I showed you, eliminate the policy if we can't get one on you, or maybe we could insure your spouse or one of your children. And then, that basically becomes a machine. 1000%. That is how you should buy the car. Do not pay cash for the car. I already showed you the benefit or the disadvantage of that.
And then final question, is it possible to roll over a term policy to a whole life?
Depends. So some term policies are convertible. We'd have to look at it. The best thing I'd say, Bobby, is just book a call with us and send us over what you have. We'll look at it. The simplest answer is more than likely yes. You can do a 1031 exchange of it or just replace it with a whole life, because what we don't want to lose is the death benefit. That's why you bought term, is pure protection. So we want to maintain that protection. But if we can do it without having to go through underwriting again, great. If we can't, as long as you're insurable, then we'll maintain that death benefit. Great question.
Right, perfect. And then Sam is in the chat with a really great question that I just want to close out on. He said, sure. Last year I borrowed from my HELOC $120,000. What will you recommend me? I'm just going to say the 3-day. The 3-day is the recommendation for that money.
Well, yeah, because you're going to hear exactly what
you're going to have. Yeah, you're going to have so many opportunities that you can pick which one works for you.
The reason she's saying the 3-day, and sorry, I'm going to put this down in the chat. This will be the final time we put the 3-day in there because someone just came in late. So that's the tickets for the 3-day. That's how you register. You get $100 off. You get a limited edition hat that was only for people that registered today. We haven't offered it any other time, and that'll be mailed to your desk. And I gave you a 100% money back guarantee. If you want your money back after the 3-day, I will mail you a check and you can keep the hat. That's my commitment to you. It's not learning how to lend. That I don't understand. 100% learning how to lend. Yes, it is.
It's learning how to lend as well as opportunities in the relationships that Chris has made. So it's not learning how to lend is classroom stuff. This is actually opportunities.
So here, let me just paint the picture. So what are you going to like at the 3-day? You're going to learn a whole bunch of stuff, but like learning how to lend. So yes, we're going to teach you how to lend. I kind of did, and I'll teach you a lot more then. But let's say if you're going to lend, who are you going to lend to? You're going to know the best places. So we're going to have a bunch of people on the 2nd and 3rd day that are going to be people you're going to want to lend to. We're going to have the Fullers, the people that I lend the most to. We're also going to have a private hedge fund on there, okay, which basically brings it down to as low. I don't know what he's going to offer. It's either 25 or probably 50 grand minimum. I think that's what he'll do. It'll be 50,000 minimum. But at 50,000, I mean, you'll probably make between 12 and 15%. I don't know what he's going to offer you guys. You know, I know he was in the experience and he did something that I'm not going to repeat because like it was literally probably above and beyond what he offered out there, but he's going to offer something really good. And if you need your money back, there's a way to get your money out of the hedge fund. It's one of the only I've ever seen. And then there's going to be other borrowers that we lend money to, like Noah and Christy. Listen, you just got to get to the 3-day. And if you need more excuse than that, then don't come to the 3-day. And then just listen to everybody else tell you why you should have been there. And you'll sit there and say, I shoulda, I coulda, I woulda. There's no risk to you for going to the 3-day. Worst case scenario, you hate it. You get yourself a free hat and you get your $197 back. What did you lose? What did you give up? Nothing. But you won't hate it and you will learn a lot and you will take out away a lot. Matter of fact, I don't know how many 3-days we've done. We've always offered that. How many people do you think have ever refunded from the 3-day? 0. Not one. You'd be the first, but hey, I'd be honored to give you your $197 back if you truly didn't enjoy it and didn't get anything from it. I don't care if you're 30 or if you're 76 years old, you have something to learn at this 3-day.
Mm-hmm. Don asked if they're recorded, and yes, they are. They're recorded, and we kind of timestamp every speaker so you can jump around and re-watch something or pick up where you left off if you can't attend the whole thing. And then Pat asked, when opening up a whole life, how fast can you borrow, and is there a cap? And we'll end with that.
When opening up a whole life, how fast can you borrow, and is there a cap? So it's immediately in the first 30 days. So your policy is issued today. You send your money to the insurance company. Let's just say you did it immediately. Let's say that day the money cleared, which usually it takes a day or two. Your money will be available immediately in the next 30 days, usually sooner than later. It's just when your bank clears the funds. So, and what is the cap? Depends on the design. Depends on your needs and goals. Depends on what we're designing the policy to be. But it's probably going to be somewhere around 80-85% that you're going to be able to take out right like that. Awesome.
Perfect.
I don't know how many folks took advantage of the offer, the risk-free offer, and we're going to be talking about risk-free returns and risk mitigation on Friday. And then we're going to go into a whole bunch of other stuff on the 3-day. Folks, I'm honored that I was able to go 20 minutes over and answer all your questions. I'm honored that you all gave me your time, and Shauna and Cash. He's very happy that you guys were here, even though he didn't show any emotion. His tail is wagging, so he is happy you're here. But with that being said, folks, we will see the majority of you Friday morning at 10 a.m. Eastern for what will be, I think, can't promise it, but I think it will be the best 3-day training and the most useful one we have ever done. Until then, have a good night, folks. All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.